Hi everyone, I'm Don Harkins with Your Florida House Team and Your Florida Loan Team. I am a Central Florida realtor and mortgage advisor with America's Money Source. Today I'm going to share with you a little bit of information that speaks to the question, are we heading for another 2006-like housing bubble? One headline that's making a lot of waves right now is that prices are 41% higher today than they were back in 2006. And that might seem like a big number. I'm going to share with you a chart. Case-Shiller is the authority on tracking year-over-year appreciation, and you can see it has been increasing steadily. So we had 4.4% at the beginning, 4.8%, 5.8%, 7%, and month over month, as we move and track towards today, year-over-year appreciation continues to gain speed. It continues to outpace itself. You see 16.6, we actually reached 18% most recently for year-over-year appreciation, and that is a big number. So when we talk about home prices being up 41%, it doesn't seem like there's a slowdown coming anytime soon. The next chart I want you to look at is our historical 30-year fixed mortgage rate chart. Back in 2006, you can see rates were over 6%. And the mortgage that I got in 2007 was a 6.4% mortgage. It seemed like a pretty good deal at the time. Today, you can see rates are under 3% for many borrowers, right at or under 3%. So in spite of some pretty steady and consistent home value gains, interest rates are still 50% lower than they were back in 2006. Another thing to look at when we're talking about whether or not we are heading for a housing bubble is how have incomes grown. You can see in 2006 the average hourly earnings were about $20 an hour, whereas today average hourly earnings are at $31 an hour. The reality is that the higher income earners and people more likely to be purchasing and owning these homes have actually seen a larger increase than some of the lower income earners. So even the lower income earners that were at the $20 an hour in 2007 still sitting at 50% higher number, $31 per hour today. So let's look at how that applies on this next chart to affordability. In 2006, if we take a $300,000 home and assume a borrower got a 6% interest rate, that would have left them with a monthly principal and interest payment of about $1,800 a month. If we assume a household income of $6,000 a month, that would have been about 30% of the borrower's or the homeowner's total household income. Today, if we take that $300,000 price and we use the media's headline of 41% growth from 2006, that same $300,000 home would be worth about $423,000. At today's interest rate of 3%, that would mean the monthly payment is $1,783 a month, actually less than what it would have been in 2006. But that's not all. Household income also would have increased, and household income would be $9,300 a month today for that same $6,000 a month earner in 2006. That would mean that the total payment to own the same home today would be about 19% of household income versus 30% household income in 2006. Meaning, even if we assume a 41% increase in prices, it's actually more affordable, more sustainable, more attainable for a borrower to purchase and own that home today at today's prices than it would have been in 2006. Part of what led to the 2006 big run-up and risk in a high inventory environment was widely available credit, subpar loans, risky borrowers, stated income, no-doc mortgages. These lending practices are what fueled that run-up in prices in 2006. That's different than what we're seeing now. Today, we actually have 12 million more households in the United States than what we had in 2006, but there are 2.5 million fewer homes on the market today than there were back then. What we're seeing today is a demand-driven price increase, and that's to be expected. We don't expect to continue to see 18% year-over-year appreciation. My hope and my expectation is that that starts to slow and we start to see more historical normalized appreciation month over month and even year over year, returning back to a 2.5 to 3% annual appreciation. However, it's important to understand that homes today are arguably more affordable at today's prices and interest rates than they were in 2006. And it's also important to understand that the people who have been purchasing homes for the last 10 years have been purchasing under revised guidelines and very conservative lending practices where they are required to put equity into the property and their ability to repay the loan is established and confirmed prior to closing. Today, most homeowners have a lot of equity in their home. The average homeowner has about $65,000 in equity in their home today. So chances of foreclosures remain low. If there are borrowers that get into distress, it's likely that they may place their home on the market, liquidate the home, retain some of the equity, and have to let some of the equity go potentially for a quick sale. But don't believe all the media headlines you see. While talking about a housing bubble works great for clickbait and great for page views and great for people who are flipping through TV channels, the reality is we're in a demand-driven, very different looking housing market today than we were in 2006, and we expect that to normalize, and we expect for the market to continue to be healthy for a while to come. Thanks for taking the time to listen. Drop a comment, send me a message if you found this information helpful. And if you have any questions about purchasing a home in Central Florida, selling a home, or getting pre-approved for a mortgage, please reach out to me, 321-377-0341, or visit our website, yourfloridahousesearch.com. Have a great weekend.